Hi, morning. Anand, before anything else, what explains this extremely flat Nifty move?
Hi, very good morning. I think, uh, look, there has been on the fundamentals front also, there are push and pulls, there are tailwinds and headwinds. As you know, that there has been a benign monetary policy to give a boost to the economy. Of late, we also seen some bit of fiscal room maneuver in terms of GST cuts, and even during the budget, we had interest rate income tax cuts for the middle class. So I think we have some bit of support from the economy, but at the same time, we have US tariff and generally a slowing global economy, which is putting pressure on few businesses which are export oriented. So I think that's on the fundamentals. The economy is actually chugging along, but it's not really making a move on the either direction. Similarly, on the flows also, we have a very strong domestic flows, but at the same time, we have foreign outflows, FIs moving out. At the same time, we have enough supply of paper, which you can see over last 1.5 years. We have IPOs, we have QIPs, we have selling by private equities. So overall, it's been a balanced market, and that's why it's been a balanced moves in the market at this point of time.
Right. Okay. And Anand, that of course, gets me to individual sectors as well. The talk today, of course, is TCS making all the right moves, talking about, AI and the data center that they're going to be setting up. But can it really materially change the fortunes of Indian IT services in the very near term, Anand?
No, the simple answer is of course not. But I think if you ask me, the IT services have had underperformance for a while now, more than 3 years, and yes, it's finding its feet, but as it is, as I said, the global slowdown impacts that sector also equally hard. And to that extent, the growth is an issue. As and when we can see some clarity on growth, as you can see some uh, spending on the IT by the global businesses starts picking up. I think the underperformance in IT coupled with some turnaround in the businesses. So we've been underweight IT. We still remain fairly underweight IT, but we would like to agree with the market that at some point of time it becomes attractive, but not yet there.
Anand, just shifting tack here. Hi, this is Harsha. Good morning. Shifting tack, how are you looking at gold and silver as plays? Do you believe that the near-term highs are made? Do you still see that there is upside given all of the uncertainty with regard to the dollar, as well as with regard to the way in which the US policy making has been? How should one look at both gold and silver?
So I think we have to look at gold, silver, Bitcoin in and then subsequently commodities in that order from a debasement trade point of view. I think this is a new word been coined where look, there is a global growth issue, and to that extent, governments after governments will have to spend money to get the growth going. And we are seeing that in US as we speak. We are seeing Japan might enter in that phase where they will kickstart their economy through some stimulus. Europe is expected to do the same, and to that extent, you have a lot of debt in the system already. On top of it, we might further double down for the growth, and to that extent, there is an expectation that inflation will remain elevated while we need to keep the interest rates lower, which means that people will find trades beyond the US dollars, and that's where the gold, silver, and Bitcoin comes into the play. I think that's broadly our view on gold, silver, but we've been all along saying that given where the equity is trading, I think it's good to have an exposure to the multi-asset. We would like to believe that investors should have enough fixed income, uh, you know, precious metals as well as equities into the portfolio in the right mix.
And Anand, what's the sense like with regard to earnings growth? Because essentially we are stuck in a zone, at least where markets are concerned. And this is how the Indian investor will think, right? We're stuck in a zone largely because the earnings re-rating or the earnings growth hasn't kicked through. Do you expect that to happen H2? Is that a slightly delayed story? Is it an FY27 story? Because markets will obviously read through it slightly ahead and make the move slightly ahead. So trying to get a sense as to how you're seeing the timing of this play out.
Indeed, I think we have to see the current earnings growth rate in the context that we had a very strong earnings growth rate for a few years, especially because we had a very weak earnings growth rate for India Inc. From say 2007 to almost 2019. So we had a weak earnings growth rate for 10 years. Then we had a very strong earnings growth rate for 4 years. And now we have sort of middled down. So if you see the corporate profit to GDP, which peaked sometime in 2007 at 5.2%, it bottomed in 2020 at say around 2%. So while the economy was chugging along, economy was doing well, the corporate India, the India Inc. was struggling with a very low earnings growth rate all the way up to 2020. Subsequently, we had almost 35% earnings growth rate for 4 years, and that really led to the equity markets against all the odds. People were thinking that there is lockdown, there is slowdown in the economy, there was Russia-Ukraine war, and there were so many headwinds to the economy, and still the equity market continued to do well because earnings growth rate was strong. I think that's got, if you see last September, we had almost year-on-year no growth. And then since then, over last 3 quarters, it's been slowly inching up towards 8 to 10%, which is still much lower than the 35% CAGR earnings growth rate that we saw for 4 years. So I think I agree with you. Equity markets at the current valuations needs much sharper and higher earnings growth rate. I think that will still remain more of a. It will start showing up in the second half, but it will show up more in FY27.
And which sectors, Anand, do you think would actually lead that earnings recovery, even though in the second half?
So I think there are two broader themes which are at the play. One is a changing dynamics of the global manufacturing. I think globally now everybody is protecting their own manufacturing, and it would be no different for India as well. And in that context, we believe metals is one particular sector which has suffered the most from the globalization, given that China had overcapacity of that of a large order in both steel and ferrous and non-ferrous. I think as the world becomes more protective, India will have no choice but to also protect its own steel industry and the non-ferrous industry. And to that extent, I think that's one area we still like. So, but otherwise, generally in manufacturing, bottom-up ideas is something we continue to look at. That's one large area for us. The other one is changing face of financial services. I think privatization of financial services, private banks, asset management, life insurance, everywhere we are seeing one structural opportunity in terms of gaining market share. At the same time, that market is also going to grow. And third area within the consumption, while everybody is more excited about goods consumption, FMCG and others, we are seeing clear trend shifting from consumer goods to consumer services. So we are overweight in segments like telecom, financial services, aviation, and so on and so forth, because services which is growing much faster than the consumer goods, which has been the traditional driver of the consumption story in India.
How are you, Anand? How are you playing consumption? If I can ask you, is it through the auto theme, which has done ever so well, and how do you look at auto at this point, given the kind of run up we've seen? Trying to get your sense.
No, as I just said that we are more overweight on consumer services over products. I think in terms of penetration, we can clearly see what's happening to FMCG, where it's fully penetrated and the growth is abysmally low in that area, broadly speaking. Obviously, increasing competition in areas like D2C brands in FMCG and paints is making things worse, but nevertheless, the growth has sort of plateaued there. Similarly, two-wheelers, we are seeing growth is not that exciting given we have seen enough penetration. So I think no doubt that the recent GST cuts would give a certain boost to the auto growth. But I think the changing dynamics, the shift from entry-level cars to SUVs, from ICE to EV, this remains disruptive, and to that extent, the profitability of the overall segment as we go forward, while the volumes might come through, we believe the margins will remain under pressure in these areas.
Sure. Anand, so good chatting with you. Thank you for joining in today.